I like starting over. I feel like we're going to do good.
Yeah, you're going to do good.
Oh, credit.
Loose.
Loosey-goosey.
Loosey.
Here we go. All right. Well, hello and welcome to the Lending Podcast. We are your hosts today. We're going to do episode 9. And we got JB, the infamous guru of mortgage for many, many decades. I like how salty you're getting as the years go by. And I'm Jeff Jones, kind of the comic relief, I feel sometimes.
Yeah. Well, if you want to turn gray quickly, just get in the mortgage business.
Yes. So I love this topic today. What are we talking about, JB?
We're going to dive into credit, and there are so many different ways that this talk can go. We have a lot of information to bring to you, and I think the main thing to know, especially for the majority of the clients that we talk to, they tell us by the time we finally have that conversation, I hesitated to have this conversation because I knew I needed to fix something on my credit, or I knew I needed to do whatever it is, right? Or I've waited for some event that I had in the past to have some seasoning, and maybe they had a bankruptcy or foreclosure or whatever, repossession in the past. And so it's so important up front, have the conversation, no matter what your credit score is. If it's 470, if it's 550, if it's 800, we have seen them all,
Right.
and we have tackled them all. And we have so many success stories that we could bring to you, that someone who applied with us with a 560 credit score and they were buying a house 45 days later.
Yeah.
And so how do they do that? Well, we have some very specific criteria that we're looking for, that we're following in the mortgage industry. And the first thing to understand is our credit reports that we pull are way different than you might find online. The Credit
100%.
Karmas and the consumer scoring models. And you've seen that, right?
Every day. So and I like that you're talking about, don't be reluctant to talk to your lender before you figure out your credit. And I think that the hesitation can cost you quite a bit of money, and it can cost you quite a bit of your program costs for getting a good rate. So the reason why we're doing this today is really to help people that are looking to apply for mortgage, if they're looking to buy a home in the next couple months. Talk to your lender before you do anything on your credit, because a lot of us lenders, that are worth their salt, are doing a soft pull up front. So it's not going to hit your score, and it gives us a deep dive into your scenario. And so we can take an entire snapshot of your credit report, look at every trade line, look at the history, and we can roadmap a way to get you to the best score possible for that best rate, without you having to pay a third party to do it, without having Credit Karma tell you what to do, because our models are what the mortgage will affect the mortgage, whereas everyone else's, it's just hearsay. Please don't believe what you hear on other influencer sites that might have quick hits to improve your credit. You got to talk to your mortgage lender. It is a different credit report than what other people see.
For sure. And what we see a lot of times is there's so much opportunity, right, with the report. So we'll pull that soft credit pull, and let's just say we get a credit report and we have a client that has a 680 credit score. And then there's obviously three credit scores, right? So we have Experian, we have Equifax, we have TransUnion, and we use the middle of the 3 scores. So if you have a 660, 680, 700, right, we're going to go off that 680. It's a good score. But the truth of the matter is, when we get that report, we can see the upside.
Yeah.
It shows us the positive point upside,
what you
based
can get
on
to.
what you could get to. So let's say it's a plus 40 on the upside. So you could go from a 680 to a 720 just by taking a few steps, and we'll coach you through that. And so the other big thing that I see is clients that do not have a credit card, do not have a revolving account at all. Now, before I go into credit cards, let me just tell you, that's very responsible to not have credit card debt. Okay. So I'm not saying.
So the first time I got my credit pulled, I had no credit active when I was younger, because I thought I was smart by not having debt.
Of course. And from a financial standpoint, that is smart, because you're not paying interest on this.
Unless you need a credit score to buy something.
That's right. Unless you want to buy a house, then you need to have a decent credit score, right? Now, we have seen some decent credit scores for clients that do not have any credit cards.
Right.
However, they have their length of history of paying on their auto loan or their installment loans, student loans, what have you, is long. So the length of history is important. But let me break that down for you. So let's say you're you're taking a test. You're in school. You're taking a test,
Yeah.
and there's 10 questions on the test. Okay, and they're all worth 10 points,
Mm-hmm.
right? And the first three questions on the test are, do you have a credit card? Do you have a credit card? Do you have a credit card? And each of those answers is no. Then the other seven questions are something else, and you get all those right. The highest score you can get on that test is a 70.
Right.
That is essentially what you're doing in the credit system. If you don't have an active revolving credit card, you are losing 30% of your available points. So if the highest credit score you can get is an 850, which roughly is what it is in our scoring system, 70% of that number is your
Gone.
ceiling. You will not get higher than that. So what types of credit cards help a client get a credit score? Well, there's secured and unsecured credit cards. And so this is why it's important to plan ahead, because if you know your lease is up in 6 months or
Right.
9 months, or you want to buy a house next year, or whatever it is, start the process early so we can help you, we can coach you, and we can say, look, let's get a secured credit card set up. Secured credit cards are really simple. You put a couple $100 with the banking institution, and you then take a line of credit against that money. So you've deposited your own cash and then taken a credit line against that deposit. So it's secured, but it's considered a revolving account, and it reports on your credit as a credit card. But you
So
don't have to get into
yeah,
debt per se.
and I agree. I think that is the fastest. Well, one of the fastest ways to get your credit to start scoring well is the secured card. A lot of people ask me, where do you get them? Sometimes your bank will actually have that product and program. Sometimes they won't. Um, so we can give advice that I always like going to the bank that they bank with, because sometimes it's just quicker, easier to work with. They already know you, so they'll give you a decent card on that. But what you want to ask is, when will this start reporting to the bureaus?
That's right.
Because that is actually the timestamp of when that card will report to the bureaus to when we'll actually see it.
That's right.
So we need to know that date that you get from
Yeah,
the
we
card you're opening.
and then you want to have probably 3 to 4, maybe 6 months of payment history, and
Correct.
it can uh, vary depending on the type of account, when it
Yeah.
starts reporting, how many months you need to really have that score show up. So let's move past that. Let's presume that, okay, you've got
Now you're
one or two
scoring.
credit
You're
cards, you're
good.
scoring, okay, or we pull your score and we see some upside. There's essentially a pie chart. Okay, there's 5 different categories that factor into your credit score, and this isn't new information per se. But let's say that you have a credit card or two or 5. Of course, we've seen clients that have 20. We're not a proponent of that per se, but let's talk about what scores, what impacts your score.
What goes into the score
That's right.
to get to that 850 perfect?
That's right. The perfect score. And
Yeah.
so one of the biggest factors is utilization, right? So
It's
utilization
a big word.
and payment history. Yeah, capacity or utilization. So let's just put it into numbers. So you have $1,000 credit card and you have $900 charged on that card. You are 90% utilized. You're
Okay.
almost maxed out on paper.
So
Okay.
$900 owed to $1,000 card, you're utilized at 90%.
That's right.
Okay.
And the quick math, what I've learned from my credit mentor, is you're losing about 90% of the possible points
Hmm.
that you could get on that trade line because you are
Okay.
90% utilized. And that's why they say
Right.
keep your balances below 10, like below 30%, below 10% of the limit would be ideal.
Yeah. So when we talk about some of our lingo, we'll hit, I like highlighting what those words mean. So when we talk about trade lines, when we look at a credit report on our end, each credit card will be one trade line. Car payment will be a trade line. Student loans will be a trade line. Outstanding balances, anything that's reporting to the credit bureaus, call each one of those a trade line. So as we work through like these percentages, the pie charts, those are just pieces of each of the pie charts.
That's right. And so you've got payment history is a huge one. Utilization or capacity is another one. And that's 2/3 of your score right there.
65%.
Exactly. So just paying your credit cards on time,
Yeah.
paying your car loans on time, paying your student loans on time, and keeping those balances low. And when we talk about keeping the balances low, we're talking about revolving accounts, credit card accounts that are unsecured or secured. If it's a car loan, make your minimum payment, or certainly you can pay
Right.
more. Paying more on a car payment does not necessarily raise your score. It's certainly not going to hurt it. But the installment debt reports differently than the revolving debt. Revolving debt is based on utilization. The installment debt is
Mhm.
just more based on length of time that you've made the payments and
Good.
timeliness of making
So we
those
talked
payments.
about having good payment history,
Mhm.
and that is how much percent of the pie?
That's 35%.
35%. That's the biggest piece is your payment history. 30% is going to be the utilization. How
Right.
much of your debt, your basically balance can you use and
Right.
have on that trade line?
And that's specifically in the revolving category, which is why
Right.
you can only get a 70 on the test if you don't have a
Hmm.
credit card. You can
Yeah.
only get, you're missing 30% of the pie,
Yeah.
right?
And then we got the next biggest. So those are the two biggest pieces. That those two things is 2/3 of your credit score.
That's right.
That's huge.
Yeah. And so,
So even if
then
we
it's,
stopped there with this episode, like that is the bulk of your credit.
that's the bulk of your credit. And 70% of your credit score is in the last 24 months of reporting.
That's
So
huge
that's
too.
another thing that
Yeah.
even if you had a credit event 4, 5, 6 years ago, enough time has
Yeah.
passed. It's going to possibly impact you still on paper, but the weight of that impact
Right.
lessens over time. So,
Right.
time heals credit. That's one of the things I always say to my clients. Time heals credit. There are other things that we can do. We're going to talk about that here in a second, for sure, to help boost the score. But over time, things
Right.
will subside, right?
Good.
And the impact of
And
those
I think
derogatory
that's, I
things.
mean, that goes into like 50% of the pie is the length of your history of what you have on your credit report.
Right. Yeah.
And so
So
that's why it's important to not pay off and then and cancel the card
here's
before
the
you apply.
here's the question we get.
We get this all the time.
Should I close my accounts?
No.
Should I pay accounts off and close them? No, because the length of credit history is
Matters.
15% of your score. So it's a big chunk of that pie. And so let's give a for instance. So because this happens all the time.
Yeah.
Let's say that we have a client that has a 10-year-old credit card. They've had it for 10 years on time. They open a new account and their score drops. Why did their score drop? Is it because of the new account? Technically, no. It's really because the
They
length of credit
lost the
history
long one.
just went from 10 years to 5
Yeah.
years. Your length of credit history just got cut in half. So if you have
And that's
five accounts,
15% of your score.
15% is a huge number.
Yeah.
So if you have 5 different accounts and you open a sixth account, it may not drop your score as much because
Yeah.
the length of credit history is going to be diluted over 6 accounts versus over 2 accounts.
Yeah.
And then also the newness of credit is 10% of your score as well. So a new credit line being added does affect your score a little bit. The length of credit history is also affected. So both of
Right.
those pieces together is what actually can drop the score.
Good.
And so one of the big things that we emphasize is not opening new lines of credit while you're in the mortgage process or
Right.
during the system. And it's not necessarily because it will kill the mortgage. You might still be qualified, that's fine, but it could affect your credit score, which then affects your interest rate. We're going to dovetail into that in a minute and talk about how the credit score really affects rate on different programs. And so that's probably the biggest piece is when you open up a new account, the likelihood of your score dropping is pretty high.
Yeah.
That can impact your loan.
Good. So to complete the pie, before we move on to the next piece of what we're talking about, I use
Yes.
piece and pie together in a
That's
sentence on purpose.
like it.
So 35%, the biggest piece is going to be your payment history.
That's right.
30%, the next biggest piece is capacity and utilization of how you're using that.
Mhm.
And 15% is going to be the length of how long you've had those credit lines opened. 10% is the new credit, and the last 10% is the types of credit that you have. That the diversified, like we were talking about, revolving. What are the other types that we have? We have like
There's an algorithm.
installment, revolving,
Mortgage, right?
mortgage,
So mortgage,
auto.
installment, credit cards, revolving accounts, student
Right.
loans, things like that. So credit scores are built on a bell curve. Okay. There is only one person in the United States today that has a perfect credit
It's
score.
not me.
There's
Just to
you're up there.
let people know. If you were asking.
I don't think it's me either, but I'm not at the other end either. So I don't know. But yeah, there's only one person, right? There's only one person. Why is that? Because the perfect algorithm, the perfect scoring algorithm,
there can only be one Neo.
A finite,
right?
And it may change tomorrow. It's a finite amount of time. So what does that mean? That means that on a daily basis, that algorithm is constantly looking at all the different pieces of this pie,
Mm-hmm.
and it is changing your score based on, again, payment history, length of credit. Your credit card statement comes out, it has a new balance, it's updated, it
Right.
reports to the bureaus, it
Yep.
affects the score. Something fell off of your credit from 7 years ago that was derogatory. Now the score organically went up. There's all these different factors that change
Yeah.
on a daily basis. So the reason that I bring up that, that perfect score is a lot of times our clients will check their score online or through an app, and the scoring models are different, which we touched on a little bit,
Right.
but the range of scores is different. So the consumer
Mm-hmm.
credit score, typically the range is from 500 to 1,000, and in the mortgage world, it's 350 to 850. So if we have a client that tells us they have a 900 credit score, we know that's a really good credit score. However, it doesn't work translate
You
to the
broke the
mortgage world.
system.
Yeah, you
Right.
broke the system. It's over it's red lined
Yeah.
over here to the right, um, because you're using a consumer model that's not necessarily the mortgage model. So the takeaway from that is when we pull your credit score,
Right.
we may pull a different score. That's normal. That's okay. But we're also going to have a roadmap to maximizing your score, which we'll
Yeah.
share with you. And it's very transparent. Here's what you
Yeah.
can do to maximize your score. Now, why is it important to do that?
And I think, it is important to do that. And I think you and I are very similar. One, since you trained me in most of what I know about credit, it is like when we talk to clients that just apply to us and we go through their credit history with them and tell them where they're at, where they could be at, what we like to do is where you're at and what that means for you with rates today is A, you know, where you could be is B. And we'll tell you, like, you still qualify, hopefully you still qualify for mortgage now. You just qualify for a better one if before we close. So we can do that credit work while you're under contract.
That's right. We can.
So it's not like it stops you from buying a home many times unless you're well below the requirements from, say,
Right.
FHA or something.
And I have an example hot off the press, and this just came to me
I
last
love
two in the last
examples.
2 weeks. So we pulled a credit report for a client. It was a 616, so 616 middle score. Financeable, yes, but under some of the program minimums and
Hmm.
just above some of our other program minimums. So it's not a great place to be. We'd love to see a credit score over 620, 640, and of course the higher the better. But she's a 616, and I looked deeper into the credit report. And this is something I tell every single one of my realtor partners, every single one of my clients. I do not care as much what the score is. I care
Right,
why the score is what it is.
right.
I'm really looking at why the score is what it is. And so in this particular instance, she had a medical collection that she, when I brought it to her attention, remembered, oh, yes, that was for my son. We took him to the ER. The insurance didn't cover it, whatever it was. Bill got lost. She moved. She never was notified that this bill was outstanding. And
Yeah.
so here we are. She's in the process of buying a home. She's 30 days away and she's just applying now, which is one of the reasons we love our clients to be ahead of that curve, get out in front of it, plan ahead. But we understand sometimes you find the house before you need the mortgage. That's what we're here for too. We'll go into supersonic mode. But she applies and we pull a 616. I see the medical collection. I say, okay, here's what I'd like you to do. Call the medical facility, let them know that you're willing to pay this account
Hmm.
and you were not properly notified because I asked her, were you notified that this bill was going to hit your credit? And she said no. And under the Fair Credit Reporting Act, you have to be notified. Creditors have to notify you in writing if they're going to put
Right,
something on your credit, unless it's an account that you've already agreed to, like a car, like a credit card, where it's implied if you don't make a payment, you're going to have a late pay.
right.
Mortgage, same thing. But on medical collections, it's different.
It's just a bill.
It's just a bill.
Right,
And she did not pay it because she never got notified. She never got the bill. And she was able to call them up, get it paid over the phone, have them delete that account from her credit report because they were reporting
hmm.
inaccurately. In a week, her score was over a 700. So 90
That's a
points
90-point swing
in
in one
1
week.
week. And now, how did that
Yep.
impact her loan? I mean, we could dive into that. It probably saved her over $300 a month on her house.
That was a good phone call.
300 or what is that?
Yes.
3,600 a year, 30 years, over 100 grand because of a $500 medical collection.
And I think that's a awesome win story. A lot of times people don't know what they don't know
That's right.
because they don't pull. a report on themselves very often. Um, Before you can pull one free report a year. That
Mhm.
has changed, just so people know. Is it every week now?
It's as often. I think it's every week. Yeah, you can
I
pull
think
it as
it's
often as
every
you want.
week you can pull a report on yourself, and there's websites you can go to do that. Annualcreditreport.com used to be one. Um, but so if somebody's going from like, say like a, that 615 to like a 625,
Sure,
that puts them into a different pricing bucket,
it
right?
does.
So in the mortgage industry, we have different product pricing buckets for credit. So we have these pricing matrices, and like on the left side will be like a credit score from 580 to 600 is this. Credit score from 600 to 620 is this. And they're most of the time in 20-point increments.
Right.
And it gets you to a better pricing point.
Yes.
So it never even hurts just to say, hey, if I do this little piece, how could I affect my credit? There's never a time when it's going to hurt to get better.
For sure.
So it
And
will always help. So this conversation of credit improvement should be with almost every lender call you have.
no question. And there are times, of course, we pull credit, and it really is as perfect as you probably could get, and that happens occasionally. Most reports though have some kind of upside.
Some kind of
Even
upside.
our 768 credit score could maybe get to 780 or 790. That
Right.
could affect their pricing on the loan. It
Yeah.
could affect their closing costs. It doesn't always. There's a lot of factors there. How much they're putting down, the property
Yeah.
type, all those things. And so we're looking at the picture again holistically. But one thing you touched on it but didn't say the word is awareness.
Awareness.
Like the awareness,
Right.
we want our clients to be aware of what is on your report. You may
Yeah.
not even know. And also, this is another thing, on the consumer side, a lot of the scoring models do not include medical collections. Medical collections
Mm.
really shouldn't be reported to credit reports now anyway, but this was an older account. It had been reported, it was just sitting there. So in the new age, a lot of the medical debt you're not going to see on credit, just like tax liens don't show up on credit reports anymore, judgments don't show up on credit reports anymore. So we've made some advancements in the credit scoring system, but there's still some dinosaurs out there, and occasionally we see
Right.
these old accounts that shouldn't be on there. But the awareness
Yeah.
is step one. And so by understanding your lending terms based on your FICO score, based on your credit score, we can then help navigate your best options. And there are many times where we pull a credit score or credit report and there is not any upside. Like we are as good as we can get on the score, and there's
Right.
various factors and reasons for that. And so the loan kind of is what it is. And there may only be one or two options, right? We don't have 12 different options to discuss with the client, and that's okay.
Yeah.
But let's have that discussion up front, especially if you know you're not buying right away. If you're a
Right.
few months away, 3 to 6 months, that is perfect time to be applying with a mortgage professional so that you can get that awareness of where you stand and build the roadmap for where you want to go. Now, you touched on the 20-point increments. Let's dive into that. So, the top tier in our credit in our mortgage world, a top tier credit score is a 780.
Okay.
Anything over a 780 is the same. You have a 780, I have an 820, we're getting the same loan. Okay. Under a 780 for every 20 points can, depending on the loan product, uh, affect your terms. Okay, so if it's conventional, typically conventional loans are very credit score driven.
Right.
Government loans, FHA and VA, are not.
Mm-hmm.
And when we're looking at a conventional scenario that someone's at a 740, 740 used to be the highest credit tier, by the way. They just recently changed this. So 740 plus used to be gold, and now 760, 770 can even be, the pricing can even be affected. The rates and terms and
Right.
closing costs can be affected based on that. So that's why it's critical
Yeah.
to have that 20-point conversation. If you can go up 20 to 40 points, because every 20 points is basically an eighth of a point in interest
Yeah.
rate. It can be.
And I think that's really good. So what I also want people to know is when you see an advertised rate through some kind of market, um, advertisement that you're seeing
Sure.
online or some kind of flyer you're getting, they'll say like rates as low as blah blah blah. They will have an asterisk at the bottom, right? And it'll tell you a little bit of what scenario of credit that person has
Right.
and how much they're putting down to get to that advertised rate. And a lot of times it is that 780 score that they're
Right.
advertising. Sometimes it's 740, but most of the time I'm seeing those ads with the 780 score. So they're giving you the best possible like
Hmm.
rate for your credit. It's not the only thing that affects your rate though. There is 65 plus factors that affect your rate.
There's a
Credit's
lot.
a big one,
Hmm.
but it's not the only one.
Yeah, and I think the other thing that we really didn't dive into on this show yet,
Yeah,
we can real quick, is the difference between that government loan and that conventional loan at
correct.
sort of that
Yeah.
640 to 650 credit score tier. Because we're seeing a lot more FHA loans right now, and the reason we're seeing more FHA loans work for our clients is well, two reasons. Number one, it's not credit score sensitive. Let's talk about lending. Lending is all about risk, right? So if the lender assesses risk, higher risk means a higher rate. Lower
Mm-hmm.
risk means a lower rate. Well,
Makes sense.
government loans, FHA loans, really don't have a lot of interest rate variance from a 620 credit score, let's say, to an 800 credit score. It's pretty similar. Under
Right.
620, you can start seeing interest rates and closing costs affected a little more. But conventional, every 20 points can affect your interest
Right.
rate, and it can affect your PMI rates, which is your private mortgage insurance. So, what we like about FHA loans in many cases is the mortgage insurance is set. It's 0.55% or zero point 0.5, depending on how much you put down. So it's a 0.5% per year, which can be a lot cheaper than a conventional loan in some cases with the same credit score. So if we can navigate through the
Yeah.
credit game, increase the credit score, help you increase the credit score, lowering your costs, lowering your borrowing costs, lowering your interest rate,
Mm-hmm.
lower your closing costs, it's a win-win-win.
Yeah, and I think that's good just to have a little brass tacks example of how the FHA versus conventional works on cost and rate. Because I had a client last week I talked to for the first time. We did their consult. For them to be an FHA loan, they qualified for both FHA and conventional. The conventional loan was going to cost them $220 more a month
Wow,
in monthly payments because the rate was higher and the mortgage insurance was higher
interesting.
for the same cost. So for the same overall out of pocket money, it was going to cost them $220 more to go conventional than FHA. And that changes that just was last week's numbers, right? So it is very specific to where rates are at for that day,
It Yes,
and so that
and
that
sometimes
that
they're
just
very
changed.
much in line. And then
Right.
it's a matter of
Usually they close.
presenting, they're closer, and then we present those options to
Mm-hmm.
the client, and there's pros and cons to
Yeah.
both, and we make a decision together, right?
Right.
Other times the numbers like that jump off the page and say absolutely let's go FHA
Right.
because we're saving
A lot of
2,500
money.
bucks a year.
Yeah.
And so it's a lot of money over time, and
Yeah.
so we can really get into a lot more of the credit requirements. I think what the takeaway really should be here is that you want someone who is going to look at the entire picture, help guide you through why your score is where it is, where are the opportunities, how can you capitalize on it, how can we plan ahead, or if we're in super crisis crunch mode, what do we need? What can we do in the next week that will make an impact?
Mm-hmm.
And where's the low hanging fruit for maximizing your credit score? And just a little background, I'm very passionate about this subject because I've been through two industry crashes, if you will, 2001 and 2008, and my credit was impacted. So
Yeah.
these are things that I've personally had to
You've
go
walked
through,
through it.
and for a long time felt like, gosh, I'm embarrassed that I had to go through it because I am a mortgage professional. And now I realize going through that process and pulling myself up by the
Yeah.
bootstraps and getting myself in a position where I can log in and see an 800 credit score, it's possible. It's very possible. So let us help you. Let us guide you through that process, answer those questions, and really put a roadmap together for you.
I think that's wonderful, and your heart has always been just super positive towards people with credit challenges. So in our branch, we always want to find a way for somebody to get to home ownership that wants to. And so that roadmap is not something that you just do alone. It's like, hey, here's all the steps, here's the letters or statements, and let us know how it's going, and we'll keep in touch with you. So it's almost like we are your partner with your credit improvement. So that is something that is part of our culture in our branch. I know some other great lenders that do that as well. So, what I'm hoping people are hearing is, find out from your lender where you're at. Don't try to figure that out yourself. And then don't do your credit improvement alone. And don't let it dissuade you from getting into the home that you hope to have.
Yeah, one of the analogies I love to use with my clients is changing the oil in your car.
Right.
So all of us, in theory, could probably YouTube how to change the oil in my car. We all have different makes and models of cars, right?
Right.
And we could probably figure it out. Now we'd have to go maybe buy some equipment, buy the little ramp that your car goes up on. I don't know, but we could do it. We could do it. How much time is it going to take? How much is your time worth? And how much time will you waste? Or you can go pay a professional at your automotive shop to do your oil change
Oh
to
my
a
gosh.
trusted advisor. So I think that's the most that's just the best analogy I can really come up with, because it's really something that
Right.
if you take on yourself and you go take the proper steps over time, you will achieve results. Yes.
Right.
However, how quickly do you want to get there?
Right.
And let us help you if you are in a little more of a hurry.
Quick story on oil changes. I did that myself 3 times in my life.
Did you really?
It's been
Oh, wow.
over 20 years since I've done an oil change. The last time I stripped the bolt out of the oil pan, and that's when I finally realized I'm paying somebody $70 to do my oil change than me
Yes.
to have hundreds of dollars worth of problems.
Oh my goodness. Yeah, I didn't
Yeah.
realize that.
Yeah. So, well, thank you so much for tuning into the Lending Podcast about credit. JB and I are very happy that you continue to look to us. If you would like to submit topics that you would like to see about us, please put that in the comments below. And please like, share, and subscribe. We appreciate you out there and look forward to many, many more of these.
Thanks so much. Have
Thank
a
you
great
so
day.
much.